19 years of solid monthly payouts, 0 distribution cuts, and 12 distribution increases. UTG might just be the income investor's dream. Quick disclaimer, I'm not a financial advisor, I'm just sharing my personal experiences. Always do your own research before investing. A 7.82% yield is pretty high for a utility fund. They're normally considered safe and boring. In past years, Reaves Utility Income Fund, ticker symbol UTG, has yielded more like 5 or 6%. But the overall market is bearish, so stock prices are down, and there's an opportunity to pick up some pretty juicy yields at the moment. We'll take a look at pricing and yield, but first I should explain that UTG is a closed-end fund and explain what that means. You've probably heard of mutual funds and exchange-traded funds, or ETFs. Investors pool their money together, and the ETF or mutual fund then invests those funds into a basket of various investments, usually stocks. A closed-end fund is also a pooled fund. The difference is that the shares are only issued once, and after that the issuance of new shares is closed, hence the name closed-end fund. In practical terms, this means that the share price of closed-end funds will be determined by market forces. Whereas mutual funds and ETFs are priced at, or at least very close to, their net asset value because the fund is constantly issuing and redeeming shares. And because closed-end funds are trading based on the demand from the market, they can trade at prices that are above or below their net asset value. And this creates some interesting opportunities that we'll get to later. Closed-end funds, or CEFs, have a couple of advantages over mutual funds. The first advantage is liquidity. You can buy and sell closed-end funds just as easily as buying and selling stocks. UTG is traded on the New York Stock Exchange, so you can buy it and sell it from any US brokerage account. And if you're not in the US, then you can use an international broker that specializes in access to US markets. For example, I use Interactive Brokers, and I'll put a link in the description to them. The second advantage of CEFs over mutual funds is that the entry point is lower. For example, the Vanguard Utilities Index Fund, ticker symbol VUAIX, has a minimum investment of $100,000, but you could buy one share of UTG for about 30 bucks. But those two advantages are fairly minor because you can get the same benefits by just using an ETF. And Vanguard issues an ETF of that utilities fund I just mentioned. The ticker symbol for the ETF is VPU. So you can see why there's a trend in recent years away from mutual funds and towards ETFs. But there are a couple of advantages that are more specific to closed-end funds. Which brings us to advantage number 3, and that is higher yield. And this is really the main reason that income investors get excited about closed-end funds. Now, admittedly, those higher yields are balanced out with less growth, but it's the ability to get your income sooner rather than later that makes CEFs particularly interesting. Now, there are many reasons for this, but as a general rule, the reason that CEFs offer higher income than those other types of investments is 3 things: leverage, active management, and to a lesser extent, the ability to do some options trading, including selling covered calls. And that brings us to the fourth and final advantage of CEFs, and that is to use the net asset value as a trading signal. This is similar to the concept of price-to-book ratio that I mentioned during the ARCC video. As I mentioned a bit earlier, the market sets a price for CEFs that is relative to its net asset value and usually not equal to it. Or to put it another way, when the market is bullish, the price is likely to be above the net asset value of the fund. And when the market is bearish, then you've got a better chance of picking up at a price below the net asset value of the fund. So the obvious trading signal is to buy CEFs when they're priced below their net asset value, or more importantly, below their average net asset value. And if you're wondering why CEFs aren't more popular, here are a couple of negatives that apply generally to CEFs. First of all, I mentioned leverage as a positive because it can obviously boost returns. And as you can imagine, it can also be a negative. As of October 2022, UTG was paying an interest rate of just under 4% on its debt. Now, if the fund manager can generate returns above that 4%, then they can boost returns. But if they can only generate a return that's below the 4%, then the leverage is going to eat into the returns. And the other negative for CEFs is fees. They're higher than the fees for mutual funds and ETFs. The fees can be broken down into interest expense and management fees. And those management fees are higher because these funds are actively managed. You're paying for the fund manager's ability to buy and sell the stocks within the fund and be better at that than you are. Now for UTG, the current fund fee is 1.42%, whereas the Vanguard funds I mentioned earlier, one was an ETF, one was a mutual fund, the fees for those are just 0.1%. And that's because the two Vanguard funds are not leveraged, so there's no interest expense, and they're not actively managed. They're just tracing an index. And the last thing I'll say about fees, this applies to all the fund categories, is that you don't pay them directly. So let's say you see a yield advertised of 7.8%. Well, that's the yield that you'll receive after the fees have been deducted. Well, here's my favorite part, the dividend history for UTG. I give it an A+. And when it comes to dividend history, the first thing I'm looking for is distribution cuts, specifically during the 2008 recession and the 2020 pandemic. And for UTG, no cuts, just increases. And in case you're wondering, the 4 spikes on that chart are special dividends. Those are one-time payments that are paid out in years when there are unexpectedly high profits. So how does UTG generate these yields? Well, they own a basket of usually between 40 and 50 stocks. And those stocks are concentrated in the utilities sector and to a lesser extent, telecommunications. The income comes from stock dividends, capital gains, they're boosted by leverage, and there's also some income in some cases from selling covered calls. So looking backwards to the past, UTG has a great history, but what about the future? What's the likelihood that they can continue this pattern of consistent distribution payouts into the future? In part 2, we'll look at the bull case for UTG and the bear case, and we'll also look at pricing, how I decide when to buy or sell it. More armchair income coming soon. In fact, part 2 is already here.